For more on the U.S. economy, Thomas Hayes joins us, founder, chairman, and managing member of Great Hill Capital. If I could, I'd play the theme song to Kool It and the Gang, because I think this market had your rip your face off rally. I forgot the stats, but the last 2 weeks, I haven't seen anything like this in a really, really long time. And today just kind of caps it off. What's going on?
Well, this is what you get when most of institutional managers are caught off sides. We've talked about it in past sessions together. Positioning was extreme. Managers were overweight cash. They had the most cash and T-bills than they've had since the pandemic lows when we didn't know we were going to get a vaccine in March of 2020, and the great financial crisis lows in March of 2009. You just can't make this up. And not only were they overweight cash, but they were the most short 10-year treasuries than they've been since the lows in October of 2018, right before you got a monster rip-your-face-off rally in bonds. So, you know, not only did we see equities rally today, but we saw the odds of a Fed hike in December and beyond plummet to 0%. And now the market is pricing in potential cuts, 34% in March, 69% chance in May, and 90% chance in June. So a complete game changer today, to say the least.
All right. So many people were wrong. You were right. You've got this pile of cash. Should we shove it all into stocks? I mean, we've got the NASDAQ up 50%. I don't recall a year when tech stocks were, any stocks quite for that matter, up as a group, up that much. Do we just close our eyes and jump in now?
Well, you know, you never want to chase, but what we're going to see into year-end, unfortunately, is a year-end chase. I think the opportunity is not going to be in the 7 stocks, the Magnificent 7 that led this year. They'll probably push higher into year-end, no question, because managers got to make their years. But I think the opportunity is in the 493 stocks that have participated much less as breadth starts to widening and we see tax loss selling on the losers largely in the rearview mirror. So what's going to benefit seasonally? You're going to see a big rally in small caps are going to start to outperform. You know, the spread between large caps trading at 18 times and small caps trading at less than 12 times, there's going to be opportunity there. And why is that going to happen? Because they're loaded with financials. People have been afraid of financials because all the financials bought all these treasury bonds, as we remember from March. They bought them during COVID when they got an influx of deposits because of all the stimulus money. They had to buy bonds. They bought treasuries just before the Fed went on an unprecedented hiking cycle, and they got bad mark-to-markets, which caused them to sell off, which caused the small caps to sell off. As rates collapse, as we saw down to 4.45 today on the 10-year yield, the mark-to-markets in these banks gets better and better. As bonds go up, their balance sheets look better, and we're going to see a bid in those regional banks, believe it or not, which is going to drive small caps. So there's an opportunity there.
Thomas, I got to take the flip side of this, or at least talk about it. When yields come down, and you're talking about the long-term yields, some traders would say, well, that's a reflection of perhaps weakness in the economy, which could be a recession, which is why the Fed has to perhaps lower rates in the future. If that's the case, I know we've been worried about a recession, but it sounds like no one's talking about any recession. We're talking about this soft landing. Is it still not possible that there could be a recession next year? Because if the economy is strong, why would the Fed cut rates?
Yeah, well, just 2 weeks ago in the Wall Street Journal, the headline article was, "Are we due for another Black Monday?" It's amazing how opinion follows trend. After price goes up, everyone becomes bulls. You know, the earnings expectations for this quarter were negative 40 basis points coming into the quarter. We're up plus 4.1%, and still estimates for 2024 are plus 12%. Very rare to get a bad year in equities in an election year. You have all the delayed stimulus infrastructure funding from the Inflation Reduction Act hitting the market, going to add fuel to the fire. So I think what you're seeing here is a situation of kind of Goldilocks, where you are getting some of the lagged effect of an aggressive tightening cycle coupled with a strong consumer and people still have jobs. And even if we get a little slowing, I think the economy can handle it. I think that companies have been preparing for a recession all year because there's been massive pessimism. And when they actually don't get it, we're going to see a continued what started a couple quarters ago, reaccelerating of margins that no one's looking for, and that's a positive thing. And then you take the dollar was down. You want to be in those stocks that are going to benefit from yield compression and dollar weakness, and a lot of multinationals have had currency headwinds. As that dollar starts to re-weaken, I think we're going to see another tailwind for earnings that's not in most models right now.
It is it's an exciting opportunity to be an investor, but also challenging. But it looks like this November to remember is going to continue. You're probably buying. Thomas Hayes, good to see you again, my friend.
Thanks, Phil. Appreciate it.
All right.